Meet Sarah. Sarah is 30 years old, has a solid job, and last year she finally did the responsible adult thing. She called a financial advisor, handed over her $50,000 in savings, and walked away feeling like she had her life together. She went home, poured herself a glass of wine, and thought, I've made it. Fast forward 35 years, and Sarah is now 65. She opens her brokerage statement, looks at her balance, and something is wrong. The number is fine, not terrible, but it should be a lot bigger. And it would be if Sarah had known about one number. One deceptively small, perfectly legal, completely normalized number that the financial industry hopes you'll never actually sit down and do the math on. That number is 1%. And by the time I'm done, you're going to understand exactly why that 1% is probably the most expensive number in your entire financial life. So let's start with the thing nobody tells you when you hand your money to a professional. Most financial advisors are not legally required to act in your best interest. I know, it sounds insane. You'd think the person managing your retirement would be legally required to, care about your retirement. But the majority of financial advisors in the United States operate under what's called a suitability standard. And the suitability standard basically says, as long as the product we're recommending isn't completely reckless for your situation, we're good. It doesn't have to be the best option. It doesn't have to be the cheapest option. It just has to be suitable, which is the financial equivalent of a doctor prescribing you the drug with the highest kickback as long as it technically won't kill you. And the vehicles most of these advisors funnel you into: actively managed mutual funds. Here's how it works. An actively managed mutual fund pools investor money, hires a team of analysts and portfolio managers, and then actively buys and sells securities trying to beat the market. And for this privilege, they charge you an annual expense ratio. The average expense ratio for actively managed mutual funds sits at around 0.68%, with plenty of popular retail funds charging 1% to 1.5% per year. Now compare that to a boring index fund, which passively tracks the market and charges somewhere between 0.03% and 0.10%. That gap sounds like rounding error, and that is exactly what they are counting on. Because here's the gut punch. Let's say Sarah and her twin sister Kate both start with $50,000 at age 30 and invest for 35 years. Sarah is in an actively managed fund with a 1% annual fee. Kate is in a basic index fund charging 0.05%. Assuming both portfolios return a gross 8% annually before fees, the results are genuinely disturbing. Sarah ends up with roughly $490,000. Kate ends up with roughly $720,000. That is a $230,000 difference for doing absolutely nothing different except picking a cheaper fund. And if you run that same math on someone contributing consistently over 35 years instead of just a one-time lump sum, that gap can easily blow past $400,000. $400,000, not lost in a crash, not stolen in the night, just quietly eaten 1% at a time while the fund manager renovates his second ski chalet. And here's the part that should make your blood pressure do something interesting. After charging you all those fees, the funds, they still lose. Because here's the data the industry does not put in any of its brochures. Over the last 20 years, over 90% of actively managed U.S. large cap funds have underperformed the S&P 500. Not some of them, not most of them, 9 out of 10. And over a 15-year period, roughly 88% of active fund managers fail to beat a simple brain-dead passive index fund. Let that number sit for a second. 88%. If your doctor had an 88% failure rate, you would find a new doctor. If your mechanic was wrong, 88% of the time, you would walk to work. But somehow, in finance, we keep paying for the privilege of underperformance and calling it professional guidance. Now you might be thinking, what about the 12% that do beat the market? The ones who are actually good? And this is where it gets worse, because the research on persistence of outperformance is brutal. Of the active managers who beat the market in a given year, The majority fail to repeat that performance the following year. There's almost no statistical evidence that past fund manager performance predicts future outperformance at a rate better than random chance. So what you're mostly paying for isn't skill. It's luck. Expensive, recurring, non-refundable luck. And then there's the financial media machine that quietly makes all of this worse. Because CNBC, Bloomberg, and every finance news outlet alive runs on one core business model: attention. And attention in finance is driven by exactly one thing: fear. Not calm, steady, boring index fund accumulation, but panic, rotation, breaking news, and the perpetual implication that you need to be doing something right now. Because the second you accept that the optimal strategy for most people is to buy a low-cost index fund, hold it for 30 years, and turn off the television, the entire financial media industrial complex collapses. They need you confused. They need you engaged. They need you making decisions, switching funds, and picking up the phone, because every trade you make, someone else is making money. This brings us to what I'd call the confidence loop of the fund industry. It works like this. Step 1. You watch financial media, get spooked, and decide you need an expert. Step 2. The advisor recommends an actively managed fund with a 1.2% fee. Step 3. The fund underperforms the market. Step 4. The advisor says the market is unusually complex right now and recommends switching funds, which triggers a taxable event and a new sales commission. Step 5. Repeat indefinitely. It's not a conspiracy. It's just incentives. Nobody in that chain benefits from you sitting quietly in a Vanguard index fund for 35 years. Not the advisor, not the fund company, not the media. So none of them will tell you to do it. And before you write in the comments that index funds are not perfect either, you're right. They are not. They offer zero downside protection, and when the market drops 30%, your index fund drops 30% too. There's no manager rotating you into safety. But here's the uncomfortable truth about that same actively managed fund: you're paying 1.2% to protect you. In 2008, the average actively managed fund lost 37%. The S&P 500 lost 38.5%. That's a whole 1.5% of protection in exchange for decades of compounding fees. A deal so bad it would make a used car salesman feel slightly better about himself. Because the biggest scam in finance isn't crypto and it isn't prop trading. It's the perfectly legal, fully regulated CNBC endorsed system of charging you 1% per year to deliver you less than what you would have gotten for free. And the reason it has lasted this long is the same reason most financial scams last. It's not dramatic enough to make headlines. There is no FTX collapse, no single moment where everything blows up at once. Just a slow, invisible, completely mundane erosion of your future, 1 basis point at a time, until the math finally reveals the damage on a Tuesday afternoon when you're 65, and it's a little too late to be angry about it. So here are the actual takeaways, because somebody has to say them out loud. Check the expense ratio of every fund you own right now. If it's above 0.2%, ask yourself what you are genuinely getting for that. Find out whether your advisor is a fiduciary, meaning legally required to act in your best interest, or just operating under a suitability standard. There is a massive difference, and most people never ask. Do not confuse complexity with quality. The fact that an investment strategy is complicated does not mean it is better. It usually just means it is more expensive. Understand that if you are a long-term investor with a 20 or 30-year horizon, a simple diversified index fund is not settling for mediocrity. It is statistically, historically, demonstrably the most effective strategy available to most retail investors. And the next time someone tries to sell you on an actively managed fund based on its recent 3-year performance, remember that 88% of them fail over 15 years, and that past performance in fund management is the financial equivalent of bragging about a high school sports record. I want to know where you land. Do you think A, active management is worth it and you found advisors or funds that genuinely deliver? B, the whole system is a legalized, slow motion wealth transfer from retail investors to Wall Street? Or C, the real answer is somewhere in the middle and it all depends on the investor? Drop your take in the comments because the split is always way more interesting than you'd expect.